Welcome to The Explainer. Now, as someone who looks at businesses through a classic value investing lens, I am always searching for that elusive combination of a durable economic moat and a sensible price. Today, we're unpacking a setup that honestly sounds like pure science fiction, but it is rapidly becoming financial reality. We're looking at the deep-sea mining ecosystem. Specifically, we're going to analyze a fascinating dual-engine business structure that's driving a monumental push to harvest critical battery metals from the ocean floor. On one side, we have an operator brave enough to take the physical plunge and deal with all that heavy capital expenditure. On the other side, we have a financier engineering a completely insulated, capital-light way to profit from it. It's a classic business quality comparison, and we're going to break it all down using their early 2026 filings. So, here is our roadmap for the analysis. 1. Deep sea mineral riches. 2. The metals company. 3. The royalty spinoff. 4. Financials and runways. And finally, 5. The path to production. Section 1. Deep sea mineral riches, exploring the massive battery metal resources on the ocean floor. Okay, let's dive into the underlying asset itself. 1,300 nautical miles off the coast of Southern California lies the Clarion-Clipperton Zone, or the CCZ. Out in this massive stretch of the Pacific Ocean, there are international contract areas where vast fields of polymetallic nodules are just sitting directly on the seabed. It's right down there, miles beneath the surface in international waters, where these companies have identified a truly unprecedented raw material base. But here is where the operational complexity and the massive capital requirement comes in. Getting those nodules out of the water is a staggering undertaking. At the surface, you have specialized vessels, like the Hidden Gem, boasting a wet capacity of 3 million tons per annum. From there, a multi-mile riser system drops 4,000 meters deep into the abyssal plains. Just imagine dropping a straw from the top of the Alps all the way down to sea level. Down there, robotic collector vehicles essentially vacuum up the nodules and send them right back to the surface. So why go to all this trouble and expense? Well, from a long-term demand predictability standpoint, these nodules are exceptionally rich in 4 specific metals: nickel, copper, cobalt, and manganese. These are the absolute critical ingredients required for the global green energy transition. We're talking EV batteries, renewable grids, the works. But beyond that, they're absolutely vital for defense supply chains. In fact, this mineral security moat is so strong that in March 2026, TMC officially joined the Defense Industrial Base Consortium, which sits within the U.S. Department of Defense. This resource perfectly aligns with securing domestic, independent supply chains for the next several decades. Section 2. The Metals Company, or TMC, the operational explorer bearing the physical and environmental risks. When evaluating business quality, you really have to understand who is doing the heavy lifting. TMC is the operator. That means they bear the full brunt of the physical and operational risks. They have to build the massive ships, manage the deepwater robotics, and handle all the logistics required to turn ocean rocks into battery-grade metals. It is an inherently capital-intensive business model, which naturally exposes them heavily to capital expenditure overruns, labor escalations, and environmental permitting delays. But the reward for taking on that massive execution risk? It's huge. $5.5 billion. That is the estimated post-tax net present value of TMC's project, derived right from their pre-feasibility study. It's a staggering intrinsic value estimate that really underscores why management is willing to push through all those operational hurdles. If they can execute, the margin of safety here compared to typical undeveloped resources is massive. Section 3. The royalty spinoff, TMCR, the financial derivative offering insulated exposure. Now, this is where a value investor's ears really perk up. If TMC is the miner swinging the pickaxe, TMCR, the metals royalty company, is the entity standing safely on the shore collecting a toll. TMCR's core asset is a 2% gross overriding royalty on TMC's operating subsidiary. What does that actually mean? It means TMCR gets the right to receive 2% of all future top-line revenue generated from those seafloor nodules. Crucially, they don't have to pay for the ships, they don't pay for the fuel or the labor. They are entirely insulated from the sustaining capex and operational cost overruns that make traditional mining so difficult. The contrast between the two business models is stark. It's the classic capital allocation dilemma. If you hold the operator, TMC, you capture the vast majority of the economic upside, but you bear all the risk of high capital expenditures. If you hold the financier, TMCR, you get pure top-line revenue exposure. Even if labor costs double or ship fuel spikes, TMCR's royalty remains highly profitable because gross effectively equals net for a royalty company. It's a completely different, highly durable economic mode, built off the exact same deep-sea resource. Section 4, Financials and Runways, a snapshot of where both entities stand in early 2026. Let's dig into the numbers, starting with TMCR right after its direct listing on the Nasdaq in April 2026. They posted a Q1 cash balance of $31.3 million. Now, despite a net loss of $10.2 million and zero continuing revenue on the books right now, the market is valuing this insulated royalty model incredibly highly, with a market cap sitting at roughly $812 million. The market is clearly pricing in the high quality of those future capital-light earnings. Over on the operator side, you have to watch the cash burn closely. TMC estimated a liquidity position of $154 million by the end of March 2026. Despite an underlying operating loss of nearly $50 million for fiscal year 2025, management communicated that they believe this $154 million gives them enough runway for at least the next 12 months. This liquidity is absolutely essential, because 2026 is what TMC's leadership is calling a year of accelerated execution. But management at TMCR isn't just sitting around waiting for the deep-sea mining to start. We always look at how management allocates capital, and here they are aggressively diversifying to widen their moat. Just after Q1 closed, TMCR announced a massive agreement to acquire an iron ore royalty on the Masabi project right here in North America. The purchase price is $132.5 million, funded smartly through an up to $80 million equity pipe and a $50 million credit facility. This perfectly aligns with their goal of supporting North American reindustrialization, turning them into a multi-asset critical minerals player rather than just a single asset derivative. Section 5, the path to production. Mapping the crucial milestones ahead. So when does this intrinsic value actually get realized? Here are the near-term catalysts. For TMC, the big hurdles over 2025 and 2026 involve delivering their environmental impact statement and securing full commercial recovery permits. For TMCR, the immediate focus is closing that $132.5 million Masabi acquisition to get terrestrial cash flow moving. But everything for the deep-sea narrative points to one massive date on the horizon, Q4 2027. That is the estimated start date for commercial deep-sea recovery. It's an aggressive timeline, and the clock is definitely ticking. Which leaves us with the ultimate value investing question. Is this a wonderful business at a sensible price? Can the macro promise of deep-sea minerals security actually overcome the immense financial and environmental hurdles required to get there? We're watching a pioneering operator test the absolute limits of engineering, while a smart financier builds an insulated toll bridge to capitalize on it. The stakes are huge, and the divergence in business quality is fascinating. Thanks for joining me for this explainer. Keep asking the hard questions, keep running the numbers, and I'll see you next time.